Hey everyone, and welcome back for another deep dive with yours truly.
With me.
You know me.
You know me.
We're going to be looking at something really fascinating today.
Yeah.
It's all about startup funding.
Woo! Very timely.
It is very timely as always.
Yeah.
We're always on the cutting edge. So we wanted to look at...
Yeah, where does all that money go?
Right.
Like when you hear about these huge funding rounds.
Exactly.
What does it actually mean?
Does it actually mean anything?
Yeah. Is it all hype?
You know what I mean?
Or is there something really substantial there?
Exactly.
Yeah.
So to look into this, we've got some really cool data to dig into today.
Yeah.
It's an analysis of 500 different startups.
Wow.
Across a whole bunch of different sectors.
Across all kinds of industries.
AI, HealthTech,
gaming.
Sure. Sorts of things.
The whole gamut.
Yeah.
Yeah.
So
it should be pretty interesting.
How this funding actually plays out in the real world. Yeah. And I have to say, I went into this,
with some assumptions.
Thinking like, oh, if they get a lot of funding, they must be doing well.
Yeah. More funding, more success, right?
Yeah. That's got to be it.
That's the narrative.
But I was really surprised by what the data actually shows us.
Yeah, it's really interesting.
So let's dive into it.
Yeah, let's unpack this data a little bit.
Okay.
So we said 500 startups, right?
Yeah.
Across all these different sectors.
Yeah.
What we're looking at is not just like the raw amount of funding that they're getting.
Right.
We're also looking at revenue.
Oh.
Profitability.
Interesting.
Market share.
So we can get like a really complete picture.
To get a much more holistic view of what's actually happening.
Okay, cool.
Yeah.
So I guess the first thing that kind of like jumped out at me was this weird correlation between the number of funding rounds a startup gets and their valuation.
Their valuation, yeah.
And it was actually a negative correlation.
Interesting.
I don't understand.
That
counterintuitive.
Like, wouldn't you think more funding rounds would mean a higher valuation?
You would think that, right?
Like they're getting more money?
They're popular.
People must be valuing them more. But that's not what we're seeing.
It's not that straightforward.
Okay.
It seems like what really matters is the amount of funding in each round.
Oh, okay.
Not necessarily the number of rounds.
Oh, so it's like one big round.
One massive round
is better than...
can signal a lot more confidence from investors.
Than a bunch of smaller rounds.
Than spreading it out over many smaller rounds.
I got it.
Yeah.
Okay, so that makes a lot of sense.
Yeah.
But before we go any further, I just want to make sure everyone listening is on the same page.
Yeah, let's define some terms.
Yeah, when we're talking about, like, profitability, we're talking about, like, the money
the company makes after they pay all their expenses.
Exactly.
Right.
Not just revenue.
Not just revenue.
It's the money they keep.
Got it.
At the end of the day.
Yeah. And, like, when we talk about valuation.
Valuation.
Like an estimated worth.
Like a price tag on the whole business.
The whole business.
Right, exactly.
Okay, cool. Just wanted to clarify that.
Always good to be on the same page.
Yeah.
Yeah.
So... Okay, so we talked about this correlation between funding and valuation. That was super interesting.
Yeah.
But what really surprised me was when we started looking at the specific sectors.
The sector-specific data.
Yeah, like which sectors are getting the most investment.
Right.
And so, like, as you might expect, AI, HealthTech, and IoT.
The hot sectors.
They're attracting the most investment.
Makes sense.
Right? Like, those are the areas where...
everyone's excited about.
Everyone's like, oh, this is going to be the next big thing.
Yeah.
But then things get really interesting when we start to look at profitability.
Yes. This is where we see a surprising twist.
Okay.
While all that money is going into AI and health tech and all that, it's actually e-commerce and IoT that are emerging as the most profitable.
Huh.
Yeah, interesting, right?
That's so interesting.
It is.
I mean, I guess it makes sense, though.
Well, yeah, think about it. Like, e-commerce, it's been around for a while.
Right. It's not, like, brand new.
It's not this, like, super sexy new technology.
Right, but it's clearly working.
It's clearly
working. We're making money.
Yeah.
But wouldn't you say that sometimes those big funding rounds, even if the company isn't profitable yet, like, it creates all this hype.
Yeah.
And it attracts talent.
Absolutely. There's definitely a halo effect with large funding rounds.
So maybe that's part of it, too.
It could be.
Yeah.
But the data suggests that you need more than just hype. For long-term success,
You got to have it.
you need a solid business model.
Okay.
And that's where e-commerce really shines.
Yeah.
Think about it. E-commerce models often have lower upfront costs.
Makes sense.
Faster paths to revenue.
Especially compared to deep tech.
Deep tech.
Where you have to...
Yeah, you've got extensive R&D.
Right. You're researching for years.
Yeah.
Before you even have a product to sell.
Exactly.
So it makes sense that e-commerce...
So they can start generating revenue much quicker.
Would be more profitable.
And scale more efficiently.
Okay, so if e-commerce is so profitable...
Right.
Why isn't everyone just pouring all their money into e-commerce?
Well, remember, investors are often looking for the next big thing.
The next big thing.
The companies that could potentially disrupt entire industries. Okay. And deep tech, with its focus on cutting-edge technologies, holds that promise.
Okay.
While e-commerce might be seen as more traditional, it's clearly demonstrating its staying power and profitability.
It's like the tortoise and the hare.
Exactly.
Slow and steady wins the race.
Exactly.
Sometimes.
This is really making me rethink my assumptions about startup success.
I know, it's fascinating.
Yeah, it's so easy to see all these headlines about these massive funding rounds.
You see the big numbers.
And you think, oh, they made it.
Yeah, instant success.
But it's not that simple.
Not that simple at all.
This deep dive has shown us.
Yeah, the data's telling us.
More funding doesn't automatically equal higher revenue.
It's a weak correlation.
Yeah, and it definitely doesn't guarantee market dominance.
Yeah. Another weak correlation.
At all.
It's interesting.
It's so interesting.
Yeah.
Okay, so what does this mean for someone like me?
Yeah.
Or anyone listening out there?
Yeah, what's the takeaway?
Who might be thinking about...
For our listeners.
Investing in a startup or even starting their own.
What does it all mean?
What does it all mean? Well, it means that funding is just one piece of the puzzle.
Okay.
It's not the whole picture.
Got it.
Success really hinges on building a sustainable, market-relevant business.
So it's not just about getting the money.
It's about what you do with it.
It's about what you do with it.
Exactly.
So if you were an investor in 2025, where would you put your money?
That's a good question.
Based on everything we've talked about today.
Yeah.
Would you chase the hype of AI?
Yeah.
Or bet on the steady returns of e-commerce? Or maybe...
I think I'd be looking for companies that are solving real problems.
Yeah.
With a clear path to profitability.
That makes sense.
And a team that can execute.
Right.
The sector is almost less important than those fundamentals.
Than the fundamentals, yeah.
Yeah.
That's a great point.
Yeah.
So to wrap things up here, I think we've learned a lot today.
We have.
This has been a really eye-opening deep dive into the world of startup funding.
It really challenges our assumptions.
Funding is important.
It is.
But it's not the only thing that matters.
Not at all.
What really counts is building a sustainable business.
Right.
That meets a real market need.
Exactly.
So thank you so much for joining us on this journey.
Thanks for listening, everyone.
And until next time, keep exploring, keep learning.
Keep diving deep.
And keep diving deep.
Yeah.
See you later.
Bye.
Bye.